I always think of average return like standing in a shower with two shower heads, turning one freezing cold, the other one scalding hot, and being like, on average, I'm at a lukewarm temperature. But in reality, I'm miserable as hell, Tim. That's the reality, right? Averages aren't always the actual. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Have you ever wondered whether you should buy term and invest the difference, or if you should do some type of overfunded whole life, or what's the better thing to do? Because we have a lot of people that are quoting these past times of the market that don't even exist today, and they feel some false sense of security when they're just going down a road to ruin. At the same time, there's people that just have immediate bias towards any type of product that's either something that they've seen designed poorly or that they've heard someone else do that maybe wasn't done right. And maybe they've even done it themselves and it just didn't quite work out how it was supposed to. Everything in finance is susceptible to this. And I've seen bias because people invested in the 90s and they still think that's how it's going to be. But the reality is that's a dream, as Tim would say here, that's probably going to turn out to be a nightmare. So we had someone comment on the YouTube channel, and the comment, it comes from Seth, and he said, let's run some numbers to see how that turns out. He's talking about this debate going back and forth. The cost for a $250,000 whole life policy for a 40-year-old non-smoking male, the preferred rate class can vary from product to product and company to company, but one quote from a reputable company I represent is about $347 per month. In 20 years, the cash value is guaranteed to be $70,018, but under current values would be $105,721, with the death benefit growing to $326,000. So the death benefit grows over time in most policies. So the cost for a $250,000 20-year term policy using the same parameters would be as low as $23 per month. So what if you took that difference, or $324 per month, and invested over 20 years at an 8% annual return? That's going to turn out to be $190,000. So clearly, the buy term and invest the difference strategy is superior. What about the rest of the story? We've brought a computer and a whiz and someone that really knows how to build this software, someone I learned from decades ago, Todd Langford with Truth Concepts. I know you want to give him a shout out. Yeah. Let's demonstrate this, Tim.
Perfect.
Not just throw some concepts that are half-baked.
Yeah, and I think, this is a common misconception that I see all the time. And one thing that kind of became clear is he's either not aware of how to actually design the policies properly, right, or he's using the wrong company, or a combination of both, right? Because
so under this premise, totally understand these numbers.
Yep. But
what about taxes? What about actual rates of return?
Yes.
Are you going to buy term insurance? And so he talked about the cost of that.
Yep.
What happens to that term after that time? Yeah.
So I want to start off right away with market history. I'm going to use some software built by Todd Langford. It's called the Truth Concept software.
Awesome.
Amazing software. Love Todd and what he does. So the first thing, when on his investment return, I want to kind of debunk that right away. He says, if I get an 8% market return, he should have started with once upon a time, I got an 8% market return, because it's a fairy tale.
Okay.
So if I pull up 20 years,
most people are still saying 10%.
Yes.
I mean, when I say most people, I'm not saying informed or uninformed. I'm just saying I still hear that all the time.
Yeah, exactly. And I heard that all the time when I started in finance, right? 8% was the most common number thrown out there. But
I always think of average return like standing in a shower with two shower heads, turning one freezing cold, the other one scalding hot, and being like, on average, I'm at a lukewarm temperature. But in reality, I'm miserable as hell, Tim. That's the reality, right? Averages aren't always the actual.
Exactly. So in the software I have loaded in front of us right here, I've got the market history for 20 years. Now, I had the reporting through 2018 in the software, not through 2019. Okay. So I went from 2018 back to 1998. The average for the Dow Jones was 6.22%.
Wow. 6.22. So you're looking at actual rates of return in the market.
And that's the average over that time.
Yep.
If we actually go through and get the actual return, though, and go through and show every year that there was a gain
because volatility makes a difference.
Yep.
Because if you lose 10% on 100 grand, now you're down to 90 grand. If you gain 10% the next year and there's no fees and no taxes, you're only back to $99,000.
Yep.
So your average return's zero, but your actual return is in the negative.
Yeah. And so in the market, on that scenario, when the positive, you get exactly what the positive is. On the negative, it's a more impactful negative, right? It impacts you worse than what it says it will.
Right.
And just as you demonstrated. So the actual return over that same 20 years, instead of being 6.22%, is actually 5.34.
So 5.34 versus 8%. Yep. So, I mean, let's just think about, I would love to run that number. Is what's 100 grand do at 8% over 20 years? What does 100 grand do at 5.32%? drastically different.
It is drastically different. Do you want to do
Yeah,
it?
let's do it. Let's pull it up. While you're pulling it up. So we're here to kind of really look at this with a more critical eye, tell the rest of the story, give more information so that people can make an informed decision.
So if we start with $100,000
Yep.
and we say, okay, we're not going to put anything into it, but we're going to now get an 8% return.
20 years.
And we're going to do that for 20 years. Then we are going to end up with $466,000.
Okay, 466.
Now let's go ahead and do a new calculator of that same thing right next to it here. And we're going to give ourselves $100,000. We're going to give ourselves, though, a 5.34% rate of return. And we're going to give ourselves 20 years. We end up with $283,000.
That's a big difference, Tim.
That's just a small difference. Yeah, that'd be fun, right? So you start the story with Once Upon a Time, but you can't end with Lived Happily Ever After because it's not actually a fairy tale anymore. It's a horror story. You just don't find out about the horror story for 20 years.
Right.
Right? And now it's kind of too late. We also haven't calculated fees into this thing yet. We haven't calculated any tax ramifications of this thing yet.
Right, and I get you might be able to put it in Roth IRA.
Yep.
You know,
that will solve the tax
so that's
thing.
fair. You might
solve
put it
the
into a retirement plan like a 401k, but you're going to pay taxes when you pull that out.
Yep.
You know, so that may or may not
brings in a tax deferral risk.
Yeah, as long as taxes stayed level, it would still be okay. Yeah. You know, but ultimately we have some issues there.
We definitely have some issues there.
And you have no term insurance anymore.
Yep.
Which here's the problem: when you don't have insurance, you use your assets as insurance, which is this like notion of self-insured. But if you have to use your assets, it means you're spending at least $1 for every dollar of insurance, if not more.
Yeah.
And when I buy insurance, I like to spend pennies on the dollar. But if I have to lock my money away, I can't utilize it. I forfeit the ability to earn a full rate of return because I can't risk it. It can't be volatile. I can't pay it down. I can't utilize it. And so it kind of gets locked away. And we'll do more videos on that concept alone, but that's a big thing.
It is a huge thing.
All right, so what's next?
So let's go ahead and do a buy term invested difference against a whole overfunded whole life policy. I'm going to use some of the same numbers that he brought to us in the question. Now, I feel like he didn't have either the right company or the right understanding how to structure the policy.
Right.
So he came up with $347 a month.
Mm-hmm.
That equals $4,164 a year as a premium payment.
Okay.
So I went ahead and ran a policy on a 40-year-old male, preferred, properly set up at $4,200 per year.
Okay.
What I came up with was, so I ran a 20-year number or 20-year scenario here, $4,200 a month in the policy. Instead of only having $105,000 in cash value on the actual, we have $132,000. Right.
Okay, so we're already 105,000 versus 132.
Yep.
That's almost a $30,000 difference.
And then he started with about a $250,000 death benefit. I started with $370,000.
Okay, so you actually got more death benefit.
More death benefit and more cash value for the same price. Right. And so this was what I consider to be
in a low interest rate environment.
Exactly.
Right.
Now I just showed the initial, just the first 20 years, but the person, if he starts at 40, is not done at 60. So I want to show more like let's go out 30 years. Let's go out 40 years and see what this thing does. Okay. So let's take it out to 80 and just see what happens. Now, this is assuming he's going to continue to put cash in it the entire time. Most likely not going to do that, but he's going to end up with a $496,000 of cash. Mm-hmm. He's going to have a death benefit of $686,000.
Right. For those people that have read What Would Rockefellers Do, or they go to freewwrd.com and get the book, you can see that the death benefit can actually benefit you in 6 different ways while you're alive to boost your cash flow, 20% to as high as 50% more with other dead assets, lazy assets, things that aren't providing cash. So that's really cool in addition to the cash value. And I think once we unlock that human ingenuity and understand how big corporations use this to benefit, long-term in a very tax efficient way, there's 2 chapters that are really phenomenal that way.
Absolutely. And it's a huge benefit to have a permanent death benefit that's guaranteed. There's a lot of ways to leverage that. So that's something to keep in mind as well. Now, I can now take this, and this shows me down here at the bottom right or left side, you'll see an internal rate of return on the life insurance cash value is 4.51%. So that cuts through all of the fees. It cuts through all of the costs on this policy and says this is what it actually did over that 40-year period was 4.51%.
Okay.
Now, I can take that and copy it. And the reason I want to kind of click on it and copy it is because now I get all of the different decibel points.
So his numbers were 190,000 if he bought term and invested difference plus.
Yeah, he'd have 250,000 of death benefit.
And 250,000 death benefit that goes away.
Yep.
And then he said that our numbers would have been 105,000. Turns out they're 132,000 over that 20 years with $370,000 of death benefit to start that grew. So we're actually a lot further ahead than he talked about, and we'll come back to this 190,000. But right now we're just looking at a 30-year and 40 years, what happens, and it's up to over 4% return with tax efficiency.
Yeah. So now I want to find showing a buy term invest a different scenario. Okay. And I'm going to start with it earning that same exact interest rate that I just got from the whole life insurance. So I'm going to paste that number in there.
Okay.
You'll see that it's $4,200 a year.
Okay.
You'll see that the death benefit in 40 years, or the cash value in 40 years, is equal. It's the exact $496,739 because I did the same number. Right. But now we have to bring in the term cost, the other costs that happen here. Right.
Right.
So a lot of times in this other scenario, whether it's a Roth or something, a lot of times it's managed money. There's fees. What do you think is a fair fee for me to throw into this number? I
mean, look, some people might use index funds like Vanguard, so that could lower it. If it's a managed fund, they're paying at least 1%.
Yeah.
You know.
So let's start with one. Well, we can show a half.
And we could always lower, but yeah,
we can do some different things. But I think one is a pretty standard number for a lot of managed accounts, and most people have a managed account, right? So if we do that, this now bottom left number shows us how much the alternate account would have to earn just to equal the whole life.
Okay.
Because you'll see the cash value now drop to 381 instead of that 400 and let me see, what was it exactly?
492. Well,
it was 496.
496.
Put a 1% fee on it. Now we get 381 instead. So if the alternate account wanted to keep pace,
and this is a big thing because when we only think in percentages instead of dollars and cents, 1% seems minuscule, but it's consequential.
Yes.
It could be catastrophic in a big way. Like we're talking about over $100,000 difference, and you're thinking, oh, 1%, you know, not a big deal. It's over $100,000.
And in the first year, you're like, it's really not a big deal. I only paid $44 in management fees.
Yeah.
But now that $44 in management fees didn't earn any interest for the next 39 years.
Right.
And then the next year you paid another management fee that was a bigger number because it's on the total
So if you love compound
value.
interest, you got to understand it has a thing called compound cost. If you lose and don't have that money working for you,
you have compound fees.
Yeah.
Right. And this is an area where the insurance agents get beat up a lot. They say, well, this is a high commission. Well, this guy collected, if this management firm collected $63,000
wow,
over that 40-year period in fees, right? That's a little bit more than the agent got paid in commission, I guarantee.
Right.
Right. So no wonder a financial advisor would be like, no, just stick the money with me. I'll only charge you 1% instead of that commission on the insurance.
Right, because the commission on insurance, I've seen it as high as 130%.
It can be really high.
And that's poorly designed because that means it's not overfunded.
Exactly.
Which it could get all the way down to 30 or less, right?
And that's a issue we see in the industry. You have to know you're with the right agent, because if you're not with the right agent or the right agency, they have to be willing to take a pay cut.
I love that I'm seeing more and more people doing the right things there. It just becomes more and more common.
And it's the long-term game, right?
People that really get it.
Yep. Yeah. If they do it right, they know you're going to have return business and repeat business. Right. So take the 70% pay cut up front and get a repeat customer for the rest of your life, right? So we've only brought that in. Now we haven't brought in taxes. We'll leave those out just in case they're in the Roth for now.
Right.
So let's just go ahead and include term insurance, because in this model, you still have to buy term.
Right. Which he had a term price.
He had a term price. I went ahead and I wanted to do like he did. He said $250,000 and $250,000. So since I was able to get $370,000, I ran a term policy at $370,000 for 20 years, just like his term policy ran. Okay. And so if I go ahead now and load that term policy in here, I did a 40-year-old male, still preferred health rating, and I went ahead and did the $370,000 of death benefit. You'll see that that brings in a cost of $464 per year to have $370,000 of death benefit. Okay. Now, you'll also see something here that in that final year when it expires, if he wants to keep that actual policy in place, because let's say he's got a health problem and he knows he can't get more insurance, the premium goes up to $7,962. Right.
So it's phased out unless he's absolutely sick.
Is going to stop paying. You're going to stop paying for that. If you went from $464 to $8,000,
1.1% of her payout.
Exactly.
There's why.
Here's why.
When you actually might die,
it's gone.
It's gone. Yep.
And so here's the other thing to keep in mind. At this point, if the person wanted to keep insurance in force, it would cost him more than the whole $4,200 he was putting into the model just to buy the term.
Wow.
So he's not going to do that. He's going to cancel this insurance. The other alarming thing about this is it's a Chicago Tribune did an article about a year ago now, and they said nearly half of all people between 60 and 70 will not have paid off their home. So in this scenario, he's saying the term's going to go away in 20 years, and you're going to have this $190,000. That doesn't replace the $250,000. If the person dies, his family still has debt, most likely.
50% of the time.
Yeah. And so were they better off? Would you rather have $130,000 in cash? And at that point on the whole life insurance, you also had $478,000 in death benefit plus $132,000 in cash, or $190,000 in cash in the hypothetical 8% scenario.
So if we put
and
the
no death benefit,
over the 20 years, the 6.3, not even accounting for the volatility, and let's say it's an index fund, so let's give him really, really great scenario here.
Yep.
But still have to pay for the insurance. What do those numbers look like?
So what would have to happen in this scenario here, where we don't have taxes in the equation, so we used a Roth.
Yep.
And I need to go ahead and cancel the death benefit of the term in that final year, so it doesn't show 8. Oh, I did 549, not 59. He's going to live to 549. That'll be a rough year. So that makes it so that alternate account had to produce 5.89% year in and year out just to equal the whole life.
Okay. Now on cash value.
On cash value. Now we pulled the number over the last 20 years. The market did 5.34
with the volatility taken into consideration, using real market numbers, not a hypothetical 8%.
Exactly. So in his scenario, if he actually got the actual returns for the last 20 years, he did 5.34. The insurance equaled the buy term investment difference model with no tax implication at 5.89.
And you now have a permanent death benefit. You could access that cash value without taxation through what's known as FIFO, first in, first out. You get to pull out your cash that you put in first, tax-free. Once you get to the place that it's growth, you could just borrow against the policy, and then when you die, they subtract it from the tax-free death benefit to pay off the remaining loan. Your family keeps the net.
Yep. So if we do
and the death benefit grew.
And if we do a cash-on-cash comparison, on the alternate account, the cash would be at $353,000 because you had the fees and you had the term insurance that you had to pay for 20 years, and you stopped paying for it.
Right.
So then the rest of the $4,200 still went in. In the insurance, you had $496 over that 40-year period.
Right. So what does he have to earn to get to 496?
5.89.
5.89.
And the insurance did it. So if he does,
which is higher than the market did over the 20 years.
Exactly. So if he just equals the insurance policy, he's behind by $142,000 in cash over that 40-year period.
With no lock-in. So the insurance, as soon as the cash value is there, it's guaranteed.
Yep.
They don't come take it back. It has a guaranteed minimum interest rate in addition to that, and it's available. The Roth IRA has restrictions.
Yep.
You can get to it. You can get to your principal without penalty. If you're 59 and a half, then you get to it. But then you might have to have hardship clauses. You might have to have down payment clauses to actually get to the interest tax-free. Well, you don't have that problem here.
Exactly.
So, and you now have a death benefit that's going to outlive you. So it means it pays to your family when you die versus one that goes away if you do the thing that you hope, which is live into the retirement years.
Yep. So then we do a death benefit comparison, same kind of a thing. Here there's a few years in which you'll see the alternate account has more death benefit if you combine the term plus that other account, if it produces at that rate. But all of a sudden that death benefit goes completely away, and that's closer to death and more likely to death when half Americans still have mortgages and still have debts and loans.
Right.
And so by the end, the life insurance has $332,000 more death benefit coverage than the alternate account would.
Right. So more death benefit, more guarantees, more safety, more tax advantage. The thing is, where we would lose is if we use the 1990 to 2000 numbers.
Yeah.
1990 to 2000 in the stock market would have beat this pretty well.
It would. Absolutely.
Absolutely. You know, you have to make sure you find the tax-free environment. Otherwise, you got to net out the taxes, and then you got to look at what your fees are. If you can get an index fund, which, you know, that could lower the fees substantially. There's two levels of that with Vanguard. There's kind of the institutional side where you get even lower fees than just an average account. So that's something that's important to note and to know. And then, you know, like I said in my book, I'm saying, how can you actually use the death benefit while you're alive? There's things like charitable trust. There's things like reverse mortgages. There's things like being able to pay down assets, knowing that it's a backstop. And so that's a bigger conversation, but I think it was important to reply and answer. And I thought he was, you know, like, I'm fine with these types of comments because I like the challenge. I like to actually call this out, and it creates the content by the users. Like, I want this to be interactive, and I really appreciate you bringing this to our attention and using real stock market numbers and showing the different variances. And so people might have to watch it a couple times to get it, but ultimately buy term and invest the difference. You're going to lose the term 8.9% of the time. You might even have taxable consequences if you can't do a Roth IRA because you've either made too much money to be able to do it, or you don't want to have full restriction on your money before 59 and a half. Term insurance is a cost. If it is in the stock market, it go down the next year, where it's not going to have that go down type of situation in a life insurance account. They both, whether it's a Roth IRA or an insurance account, have liability protection and bankruptcy protection, which is really nice. But if you're investing by term invested difference outside of an IRA, you don't have the protections like you do inside of your cash values. So I think it's important to look at the big picture and the multitude of benefits and understand how it works overall versus kind of in isolated fashion where we're not using realistic numbers. So Garrett Gunderson, Money Matters here with Tim Carden. Hopefully this helps you out. Go ahead and comment if you have questions. I'm on here all the time answering them. I've been off a little bit recently. A lot of good things going on. Excited to share them with you. But ultimately, I love to respond.